Hello everyone and welcome. I want to just quickly show you guys a trade I took today on my live account and was kind of interested in breaking down something I made a mistake on and how it can help you guys in the future secure a little bit more profit. Okay, so what we're trading here is gold. I was analyzing this from the 1 hour time frame, and before we get down to the nitty gritty, let's go ahead and identify that we are in fact in a uptrend on gold going into a slight accumulation phase on, I guess you could call this the 4 hour or daily time frame. Now, dropping back down into the 1 hour, let's kind of identify where this trade went wrong and some things I could do better and some things you guys can learn from my mistakes on. So, the initial time of this trade was at, I believe, right here at 8 o'clock EST, so the open of Tokyo market, or excuse me, the open of the Tokyo market. And the trade was a 1 to 2 RR approximately going for a long, and let's go ahead and just quickly briefly draw this up. It's not going to be exact, guys, but I'm just going to show you what I was essentially targeting. And actually my take profit was a little bit lower, right about there. It was actually just at that exact point. It was a little lower, it's about right there, but that doesn't matter for the sake of the video. So this is approximately correct about where my levels were for this trade. And I just want to show you guys a mistake I made and how it can really help you out. Especially, I find that this has been recurring in the market a lot lately. And in terms of ranging markets, this is a really solid thing you can add to your tool belt in terms of knowing what may happen when trading a range, especially at the low or high. So, analyzing this a little bit further, let's go ahead and identify that our range's bottom is near, I guess you could call it a block of 25 to 22. Let's go ahead and just throw up a rectangle really quick for that, just to show as a visual marker what we're doing here. Throw that up. And let's just move this down a little bit. And this is just kind of rudimentary, guys, kind of just, throwing it up quick. Not going to be an exact level for analysis, but it's going to do for the video. So as we're looking here, my entry was based off of this low of the range here. I got in what I thought was going to be a push upward, but then my trade reversed on itself after, just about 3 or 4 hours. So what happened? What went wrong? Okay, guys. So as I said before, we're in an overall uptrend. However, we were going into accumulation phase. So why is this important? And what is accumulation? What is a range? So accumulation or range is just where the market is not making a new high or new low via a trend. So as I kind of went in this accumulation phase, I know that since gold is in an overall long-term uptrend, I'd prefer to be taking buy positions here. So when a trend or an accumulation phase, it's near its low of its range, I want to be taking buys there and possibly targeting the top of that position, or the top of that range, or even sometimes looking further beyond that. But in this case, I was only targeting the top of the range. So what are some things you can do to avoid getting this SL like I did here? Because as you can see, my stop loss was near the bottom of price, or the price of this specific structure. And we went about, let's call that, $4 or $5 below that. And why did that happen, right? I got swept. My liquidity got pulled. And how did I know, or looking back at it, how did I know this was obvious now that I actually take a little bit closer look at the trade? Bad analysis on my part. I should have known this was going to happen. And there's actually a way to not 100% definitely know, because there never is a definite thing in trading. But in trading, we can give ourselves a big advantages by predicting what may happen based on the past. And I've seen this pattern play out in my almost 6 years now of trading many, many times. And it often comes from this retail pattern called triple bottom or triple top. In some cases, if you have a triple top, the reverse is true. In this case, we're going to be looking at triple bottom. So what we're seeing here is a 1, 2, and a 3 at this point, triple bottom reversal. And so in my mind, I'm playing this triple bottom reversal on this range. And things like this, in terms of retail sentiment, retail patterns, they work in generally numbers of 3, like a triple bottom or triple top. I mean, that's a common phrase you've definitely heard if you're a trader. So why did this triple bottom not hold right away, get pulled, and then reverse to what would have been a good take profit? Now, in this case, at least in my opinion, now everything I say is, of course, my opinion, so take it with a grain of salt. In this specific trade, smart money, I'm just going to use that term loosely here as either a bank, a financial institution, or a large player in the market, is harvesting my liquidity. And by me, I mean all of our retail trader friends here, and collecting fees if they're a broker by kind of jigsawing the market around, flipping it back and forth. So what happened, right? So our entry here is at the low. Price quickly moves down here, but I want to also highlight why price quickly moved down and some times you can avoid for this to happen to yourself. Generally speaking, I've noticed this during my trading, is that there's about a time frame range between 2 hours to an hour between a major market opening. For example, at 3 a.m. here, all these times, by the way, are in Eastern Standard Time, New York time. So about 2 hours before, you're going to see what's I like to call potential for a reversal. So at this point here, we're getting a liquidity grab before the 3 a.m. open of the London session, and then we're seeing continuation throughout London into New York of this, I guess what you would call a top of this range. But what's important here is that these reversals or these slippery movements of price, where price can move one way or the other very fast, and the opposite direction of what is the supposed support or trend, can happen, like I said, 1 to 2 hours before that major market open, which is that London session at 3 a.m. Right here. So just want to let you guys know, heads up, if you're looking for a trade or looking for an entry that's more precise and you don't want to get stopped out by taking the bottom of support on a triple bottom, you're going to be trying to kind of identify, okay, when's that major market open? I'm going to be a little bit more attentive 2 hours prior to that. I'm going to see if we get a slide of price. You know, if we get some price action that looks a little bit quicker than what we'd expect. For example, this, just like that, it catches itself, we move back down. This could be an entry, and then as you can see, price runs up heavily. And now what I want to make note, guys, here is that I don't advocate for extremely small stop losses, because I think you want to give your trade a little bit of room to run. So let's say I mess up my entry. Let's say I even got in at the exact bottom of structure here at about 20 from this previous low. If I had a $10 stop loss on gold, I would have been okay. So when you're finding these trades, give yourself ample room to be wrong and to be right. Now lower your risk for the trade so they don't destroy your account, but what you're doing is giving yourself a higher RR at a lower risk. For example, if this would have been perfectly done, the max I could have go ahead and taken here is what? About a 3, a 1 to 3. Very solid stuff. Now this is a fantasy world we're living in here. Not the exact conditions. Let's say we take a 2, whatever. So instead of kind of trying to catch that next, I've heard it described before as buying on green. Instead of trying to catch that next huge explosion of price, you know, like every other retail guy is, let's say you're buying here because it looks like, oh, price is retracing, coming back to the high. It's gonna come up from here, guys. Wrong. In some cases, especially on a triple bottom formation, go ahead and watch out for this and be mindful of this and what's happened here for me, and apply it to your own trading. Because if you give yourself, and when I'm talking about gold here specifically, but this does happen on other instruments, give yourself about a $5 to $9 range. After a low has been broken, let it move for $5 to $9 and see if you can find an absolute bottom. Now, you're not going to be able to exactly pinpoint it every time, and you're probably not ever going to be able to exactly pinpoint it ever, and that's okay. You don't need to, guys. But what's super important is that if you can just wait for a break when you're in a trending market, something that you identified is in a ranging market. Completely disregard trending. Ranging market. This is a range market trade. When you're in a ranging market and you've identified that the low has been broken or that it's likely to be broken, let it go ahead and move for 5 to 8, 5 to 9 points and try to find an entry in there and give yourself a decent time for stop, or a decent room for a stop loss. Because when you're in a range like this is a bread and butter setup. Get in low, sell it at the top of the range. All right, guys, if you have any questions about this trade style or about this trade breakdown, please let me know in the comments. I appreciate you guys for watching, and I'll catch you guys in the next video.